Back in the 1970s, the UK and Norway struck massive oil and gas reserves in the North Sea at the same time, which promised a golden age for both nations. But what followed were two very different stories. Norway took this windfall and built the world's largest sovereign wealth fund, now worth an incredible $1.7 trillion. The UK, however, missed out on a national asset that could have been worth up to £400 billion. So what did Norway do right, and where did the UK go wrong? That's what we'll be looking at in this video, and importantly, we'll also ask if the UK is repeating the same mistake with a new asset class in Bitcoin, and how Norway's fund is already gaining exposure to it, at the same time as the UK Treasury dismisses the idea of a Bitcoin strategic reserve. Just a quick reminder that nothing contained in this video is financial advice, and let's jump in. Norway discovered the Ekofisk oil field in 1969, and on the discovery of this oil, the Norwegian government adopted the principle of a qualitatively better society. And this philosophy was the key to turning a one-time natural resource in oil into lasting social and economic benefits for everyone. To put it simply, they built a more cohesive and equitable society by providing citizens with greater equality and universal welfare. Norway was so successful at creating a welfare state that by 1976, according to a Gallup poll, 76% of Norway's 4 million population felt that they were too well off in comparison to the rest of the world, with a 1976 article in the New York Times describing Norway as a large and growing middle class of factory workers living nearly as well as their bosses. Here's how Norway achieved this. At the discovery of oil, Norway limited annual spending of oil revenues to around 25 billion Norwegian kroner, which is about $4.2 billion in today's terms. It did this to prevent inflation and fiscal imbalances, making investments towards building long-term national capacity. However, a banking crisis in the late 1980s, triggered by overinvestment in physical infrastructure and heavy industry, was a significant reality check. So in the 1983 Tempo Committee report, Norwegian economists advised the government to invest most of the oil money abroad to avoid the Dutch disease, also sometimes referred to as the resource curse. The Dutch disease is an economic phenomenon where a sudden boom in one sector, typically the discovery and export of a natural resource, leads to a decline in other sectors, particularly manufacturing and agriculture. Why Dutch? Well, let's take a look at the Netherlands back in the 1950s, because that's when they discovered the massive Groningen gas field. By the 1960s, the gas exports are growing, but the Dutch economy is in decline. So what's happening? Well, their currency, the guilder, had shot up in value because of all of the revenue flooding in. And a strong currency may sound great, but it comes with a downside, because Dutch exports, like manufacturing, agriculture, and even tulips, became more expensive on the global market. And since their exports couldn't compete, factories began to struggle, citizens lost their jobs, and the economy began to crumble. So how does this resource curse actually work? Well, imagine if the Norwegian government had spent all of that oil money at home rather than abroad. It would have set a trap for itself. First, the oil sector would have paid such high wages that it would have sucked all of the talent away from traditional industries like fishing or agriculture, which simply couldn't compete. Second, all of that foreign cash flooding in makes the currency too strong. And while that sounds great, it makes all of your other exports too expensive for the rest of the world to buy. Your economy therefore becomes dangerously dependent on that one resource. And when the price crashes or the wells run dry, the whole country suffers. But Norway recognised this trap. That's why, instead of spending the money at home, they saved it and invested most of it overseas, buying up foreign stocks, bonds, and property. The money eventually returned as investment returns, but the slow pace prevented sudden, huge increases in domestic spending and inflation. That brings us to the next big point, the democratic structure of Norway's sovereign wealth fund. So in keeping with its vision to create a cohesive and equitable society, Norway claimed sovereignty over its resources in the 1960s. After that, it enacted laws declaring that resources within its territory belonged to the Norwegian state. That's why, while oil exploration began in 1969 with foreign companies, by 1972, state-owned Statoil and private Norwegian companies such as Saga Petroleum had become central to the exploration process. So when the Tempo Committee proposed the Dedicated Sovereign Wealth Fund in 1983, the money from state-owned Statoil and its investments finally had a home to flow into. As a result, the Government Pension Fund Global, which is its formal name, was set up in 1990 with its first transfer in 1996, with a mandate that governed fiscal policy for informed decision-making regarding market oil volatility. It also began to plan for the future needs of an aging working population, create a plan that would take into consideration the decline in production and income, and also ensure that Norway can create intergenerational equity from this windfall. So as you can see, Norway was thinking decades ahead to secure its future. It didn't sacrifice detail over short-term financial or political pressures. So what does Norway's Government Pension Fund Global invest in? Before 1996, the fund's focus was on government bonds. However, in 1998, the fund established the Norges Bank Investment Management as fund managers, which you can see the huge value of now from its website. Since the 2000s, its portfolio has widened to include emerging market equities, corporate and securitized bonds, small cap companies, and unlisted real estate. Today, the Government Pension Fund Global allocations include equity investments at 70.6% of the fund's total investments, fixed income at 27.1%, unlisted real estate at 1.9%, and renewable energy infrastructure at 0.4%. And to put this into context, the fund holds shares in about 9,000 companies across 70 countries, which equates to nearly 1.5% of all listed companies globally, as well as owning hundreds of buildings in major cities. For example, in March 2025, it bought a 25% stake in London's iconic Covent Garden for £570 million. And in January 2025, it made a £306 million investment, for a 25% stake, in the Duke of Westminster's Grosvenor estate. What that means is that Norwegians pocket a share of the UK rental income. At the same time, the UK spends billions as a net importer of Norway's crude oil and natural gas, adding even more revenue to Norway's trillion-dollar fund. And that's how a country with a population of just over 5.5 million people managed to build a huge $1.7 trillion fund. So while Norway was succeeding at creating a well-funded welfare state, the UK had different economic ideologies. It all began with the discovery of gas and oil on the small Montrose field in 1969, the first commercial UK oil field discovered in the North Sea, and the giant Forties oil field that was discovered by BP in 1970 that really started everything. At the beginning, UK oil fields were actually producing much more than Norway, which we'll come back to in a bit. However, this new oil wealth arrived at a moment of national crisis. In the early 1970s, just as the UK's oil began to flow, the global oil shock recession hit an already vulnerable British economy. What followed was a 3.9% decline in the UK's GDP, and by 1975, actual inflation had soared to a post-war peak of over 25%. The situation was so dire that for the first time since World War II, the UK required an IMF bailout in 1976, with part of the IMF bailout conditions including drastic spending cuts and austerity measures. And there's been speculation recently even that the UK might be needing another 1976-style IMF bailout due to the state of its economy. But moving on, when the oil revenues came flooding in, the then Labour Prime Minister James Callaghan said that oil was God's gift to the British economy. However, as Norway was squirreling away its oil revenue to build a cohesive economy, at the top of the UK's list of priorities was meeting its immediate fiscal needs. So this meant massive tax cuts, financing, managing public debt, or responding to the economic pressures of the day. Or in other words, the focus was on the present rather than on the future. Ultimately, Norway's oil resources were under democratic control, while the UK's resources became privately owned. This began with Margaret Thatcher, a stout supporter of free market economics, who came into power in 1979. Under her economic philosophy, the government sold state entities like British Gas and British Petroleum, or BP, in the 1980s to private entities. So the UK government didn't directly own or control its oil and gas revenues at the time. Also, in Norway, the state could govern fiscal policy for proper decision making regarding its oil resources. This is how the Norwegian government earned $30 per barrel of oil by selling it when prices were high. Meanwhile, the UK continued to sell oil even when prices were low. This means that when global oil prices slumped, as in 1978, to $14 a barrel, the UK continued to sell. Why? Every barrel sold generated revenue. And with taxes like the petroleum revenue tax increasing to 75% by the late 1970s, even low prices meant billions for the Treasury. This then brings us to the erratic tax measures that the government took with oil revenues, because it turns out that when the UK struck oil, the government implemented an aggressive tax regime, which it still does today. By 1975, they introduced the petroleum revenue tax at 45%, which, when you combine that with corporation tax and royalties, the total effective tax rate jumped to around 83%, even higher than the headline rate you can see here on the graph. And it didn't stop there, because by 1979, petroleum revenue tax was at 75%, while the total government's take from all these combined taxes could well have been over 90%. As the graph shows, this created a massive tax burden that peaked in the early 80s. So what did these huge tax rates actually mean for the Treasury's bank account? Well, it of course meant significant revenue. In the peak year of 1984 to 1985, the government raked in £12 billion, which was about 3% of the entire UK GDP. But here's the most important part of this entire story. Instead of saving it like Norway did, the UK pumped most of that money into its short-term needs. And another point is that the UK tax rates and approach were inconsistent, which made revenues volatile. £12.4 billion in 2008 to 2009, down to £500 million by 2020 to 2021, then back up to £9.9 billion in 2022 to 2023, with us obviously knowing what was going on in the UK, talking about oil at about that time. But the tax changes didn't just affect the government's budget, they shaped the oil industry itself. High taxation made some fields barely profitable, slowing exploration in tougher areas. And by the 80s, the government realised this and cut down on taxation, scrapping royalties for new fields and adding reliefs. That sparked a boom, with UK production peaking in 1999 at 1.7 million barrels per day, outpacing Norway for a time. The problem with this strategy is that while lower taxes boosted output, there was a cost. The UK got less per barrel at $11 compared to Norway's $30. And this large-scale production approach wasn't sustainable. As you can see from this graph, while the UK's production fell sharply after its peak, Norway's steady management meant their production continued to grow, overtaking the UK's in the late 90s and staying higher for longer. Essentially, the tax system allowed companies to retain more profits. By the 2000s, when the UK tightened its taxes again, production was already in decline. So inconsistent policies forced companies away from aging fields. As a result, the UK reserves are at 3.3 billion barrels of oil, while Norway has 5.4 billion barrels of oil. And as this graph from the North Sea Transition Authority shows, that decline is set to continue, with UK output now less than half of what it was just 20 years ago. So did the UK catch the Dutch disease? Well, yes it did, because in the early 1980s, oil production was high, and at the time, the pound's value was relatively high also. But when oil prices later dropped, it triggered a recession and a steep fall in the pound. For example, in the early 1970s, £1 was worth $2.50, but by the 1980s, this value fell to lows of $1.05, crippling British exporters and leading to a devastating decline in British manufacturing. So by the 1980s, Britain's welfare state dream was fading and was showing a significant inequality between the poor and the rich, which was likely widened by high earners from the oil boom investing in property, which drove up housing costs for everyone else. To make matters worse, instead of investing the oil revenue, the government began privatising public housing, selling off social housing, while also reducing public sector investment from an average of 4% in the 1970s to about 1% in the 1990s. As a result, today the UK has a severe housing problem with an estimated shortfall of around 6.5 million homes. While the UK has a home ownership rate of 63%, and it is still declining by the way, Norway's home ownership rate stands at 81.5%, partly due to pro-home ownership policies. So just how much money did the UK miss out on? Because economists have calculated it. The sale of Britol in 1982 brought in over $1 billion for the cash-strapped UK government. However, data shows that had it remained a public entity, it would have generated over $400 billion in revenue for the public. And if the UK had a $400 billion or pound sovereign wealth fund, each citizen would hypothetically own an average of over £5,800, or at least it could be used to invest that and grow further. Or, if you look at it from a different angle, a £400 billion fund would cover about 13.75% of the UK's current national debt, making a significant dent in the country's outstanding obligations. And when we look at Norway to compare, we can see why this matters. Norway's sovereign wealth fund means that every citizen has a $300,000 share of national wealth. There's therefore accessible quality education and healthcare, which has contributed to Norway's place as the 7th happiest nation on earth. The UK, on the other hand, needs high taxes and debt to fund its public services. So its citizens' happiness rank in the UK is in 23rd place in 2025, with a lower GDP per capita of $49,000 versus Norway's $88,000. So this brings us to today. In October 2024, the UK formally established a new national wealth fund with an initial $27.8 billion in funding. While its current investment focus is on green and high growth industries, its very existence gives the country a second chance to make the kind of long-term strategic investment that it missed out on with oil. And that brings us to the new asset on the table, Bitcoin, because the parallels to the 1970s are clear. The debate's already underway, with Lord Elliot of Micklefell formally asking the government what consideration they've given to establishing a strategic Bitcoin reserve for the UK, as well as many other parties and advocates. The Treasury's response to the many requests it's received now are a firm no. Citing volatility, they stated that the government has no plans to adopt a strategic Bitcoin reserve. And just like with North Sea oil, this is where the UK and Norwegian approaches diverge once again, because Norway's approach allows it to stay within its normal investment rules, but still benefit from Bitcoin's success. This is because while state pension funds can only invest in a set of asset classes, such as equities, bonds, or fixed income securities, Norway's asset fund does have exposure to Bitcoin, even though they don't hold it directly. For example, since 2024, the fund has increased its crypto holdings by a huge 192%, according to K33 research. That's exposure to about 7,161 BTC through smart proxies such as Treasury companies, Strategy and Metaplanet. Also, it's increased its Coinbase stock holdings by 96% during the same period. Plus, they're also holding over 11.9 billion Norwegian kroner, which is about $1.2 billion in strategy stock, a 133% increase from last year. But unlike Norway's government, which doesn't hold Bitcoin directly, as we speak, the UK government holds 61,245 BTC, which makes it the third largest government holder worldwide, after just the US and China. And the UK BTC stash, that has a rough value of 7.2 billion US dollars, which is entirely from criminal seizures rather than purchases or strategic reserves. And the very fact that these assets were seized is a powerful reminder of just how important it is to control your own crypto security. That means keeping your assets on a secure hardware wallet or cold storage device like Trezor, and I did a review of its latest top-of-the-range model, the Trezor Safe 5, that you can find a link to here and the description of this video. After that, the next crucial step is securing your seed phrase. CryptoTag is the leading and best-selling storage device for that, and I recently did a review of the CryptoTag Zeus model that you can find a link to here and in the description of this video. Since the UK Treasury has no plans for a national Bitcoin reserve, unlike the US, which is supposed to be planning a strategic Bitcoin reserve, the UK might well end up just selling its Bitcoin holdings to address its short-term fiscal needs. And what does that remind us of? Selling off a valuable long-term asset to plug a hole in the budget. Because the question here is whether this is the same short-sighted logic that cost the country its North Sea oil fortune, because it looks like policies are not being driven by long-term wealth growth or innovation. The UK instead is so cautious about Bitcoin's volatility that it's prioritized regulation and so-called stability with no risk over the opportunity to invest in long-term national benefits. At the end of the day, policymakers need to look past next week and fully consider the multi-generational impact and the power of compounded returns. And if you're looking to learn more about crypto and the crypto space, I do offer one-to-one coaching to those who are genuinely interested in educating themselves. So please check the description of this video for links where you can message me and book in a free video call to see if we'd be a good fit. So to summarize, both the UK and Norway hit the jackpot with massive North Sea oil and gas discoveries in the 1970s. While Norway played the long game, channeling its windfall into a sovereign wealth fund, the UK spent their revenue on short-term fixes. The result? Economists estimate the UK missed out on a £354 to £400 billion fund. Fast forward to today, Norway's fund has indirect exposure to Bitcoin, while the UK holds over 61,000 BTC, but lacks any kind of strategic reserve plans. So should the UK reconsider its strategy and establish a strategic Bitcoin reserve? I'd love to know what your thoughts are in the comments below and on this video on Norway versus the UK. Please do also like the video, subscribe to the channel and turn on all notifications, as it honestly makes a big difference and does help the channel. If you're looking for an easy way to track and stay on top of your crypto investments, you can check out CoinStats, which is the leading cryptocurrency portfolio tracker. And you can find a link to their official website in the description of this video. There's also Coinly, which is one of the best automated crypto tax platforms out there. And you can sign up for a free account using the official link provided in the video description. If you're looking for more personalized support with your crypto taxes, Miner, a part of the Nephos group, is one of the leading UK crypto tax accountancy firms around that provides expert crypto tax advice, as well as services such as wealth management, restructuring and offshoring. And you'll find a link to contact them directly in the description of this video. And for our US viewers, there's a link in the description to contact Crypto Tax Audit, a leading crypto tax company in the United States. So if you need any help with your crypto tax planning, definitely check them out. But thanks for watching, and I'll see you in the next video.